Did you know that decentralized finance, or DeFi as we call it, is about much more than just lending and borrowing? There's also a growing trend in insurance. Now, to be clear, I'm not talking about insurance to protect your crypto assets if you got hacked. I'm talking about using blockchain technology to rewrite the rulebook when it comes to actually providing insurance for home, car, life, or health insurance. The idea is that crypto holders, and that could be people like you or me, we pull out Ethereum or some other crypto asset into an insurance risk pool. That means that you or I could get a share of insurance premiums that have not been spent on claims. Now, to help me understand it better, I spoke this morning with Joe Corrigan. He's the CEO and founder of autonomus.insure, a DeFi insurance startup.
But I think this is healthy for the business. I think it's wiping out some of the more fluffy projects. I think it's the beginning. I think it's the beginning of tremendous change.
Here's the thing. While platforms like Maker and Compound account for the lion's share of the total value locked into the entire DeFi ecosystem, decentralized insurance networks like Nexus Mutual, Insure, and EtherRisk are also increasing their presence. To give you a sense of the size of this space, at the end of last year, there was around $250 billion in total value locked in the DeFi ecosystem. Now, however, this year that has fallen to below $100 billion, largely due to the macroeconomic uncertainties of post-COVID lockdowns and the war in Ukraine, as has everything else. However, there's still some good reason to be bullish about decentralized insurance. On the one hand, the insurance industry is ripe for disruption. Remember when Jeff Bezos said, "Your fat margin is my opportunity"? He could have been talking about insurance. On the other, it is one of the most unpopular industries as well as one of the most profitable for the risk takers like Warren Buffett. It's an area of emerging technology that I've been working in since 2015. Back then, all of 7 years ago, the big promise for insurance was peer-to-peer insurance. It didn't take off, but the concepts can be seen in today's decentralized insurance products, such as automated and personalized risk pricing, smart contracts for paying claims automatically. Policyholders keep the unspent profits instead of them going to shareholders. In a decentralized insurance model, the operation is democratized. Everyone in the syndicate gets a vote and a say. It's not only fairer to the policyholders, the insurance company has significantly lower overheads, and the cost of insurance is reduced. Now, to be clear, these are early days and the insurance industry is still a $5 trillion super tanker. If it was a country, it would be the third largest economy in the world. It's not going to get knocked off course easily, and it has remained largely unchanged since the 17th century. So without further ado, let's get on to my conversation with Joe. Oh, and hang on, because at the end, I'm going to give you a discount code for a very special offer. Hi, Joe. Great to meet you. I appreciate you giving me some of your time. Whereabouts in the world are you for our listeners?
Likewise, Rick, I'm in Melbourne, Australia, down under.
Yeah. So what time of the day is it for you?
It's 6 p.m. So excuse any noise of my boys in the background. They should be okay, but you never know. They can barge in any moment.
Well, I'm in Spain and it's first thing in the morning. So the sun is just coming up as I look out over here. And so if any background noise is my wife getting up shortly and coming around. So look, so Joe, look, we met on LinkedIn and we both kind of work in this, in similar areas, and the intersection of insurance and decentralized finance and blockchain and stuff is an area of interest to me. And you have a DeFi insurance startup, I think, if that's the correct word to describe it. So, in layman's terms, what's it all about, Joe?
Sure. So let me try and simplify it as possible. Essentially, we match customers that are seeking insurance with what we call cover pools. So cover pools are based by and large on what we call stablecoins. And I can talk through a little bit of that if you wish. But basically, where conventional underwriting, we're doing it on-chain, meaning it's on the blockchain, so that it is visible, transparent, and immutable. So people are able to see what treasury, what reserves are available, and what is locked into a risk pool, we call it a cover pool. So if I can give you a little bit of the background so I can sort of talk through how this all started.
Love to. Yeah, love to hear it. Yeah.
So I'm the former founder of three insurance technology and services companies. I've advised several prominent life insurance carriers in Southeast Asia as well as South Africa, mostly around the M&A activities. I moved back to Melbourne after being quite a long-term expat living in Asia 18 months ago. The depths of the COVID lockdowns here in Melbourne, which were particularly bad. I had just gone through a failed venture where I was trying to build a semi-autonomous software platform that was matching drivers with riders, bypassing what we call the bloated rideshare apps like Uber and et cetera, et cetera. Now, that venture failed for a variety of reasons, mostly to do with the lockdowns. Yeah. It started me thinking, how do I apply some of these blockchain technologies, which were rapidly emerging, with some of the understanding and insight that I had developed over the years working with insurance carriers across different jurisdictions. And interestingly enough, I Googled some keywords just like you described, and up popped an article around the company called, or the project called Teambrella from memory. From my understanding, that is now ceased to operate. I think that was back almost 5 years ago. So an interesting, I guess, radar or point of reference. What if I was to tell you that I think from last estimate, in the next couple of weeks, that there will be the world's first licensed life insurance company based on using Bitcoin as its treasury, its only treasury reserve. Most people in insurance are like blown away, because I think most people's perception of Bitcoin and cryptocurrency is that it's one of just speculation, scams, and all sort of negative connotation. But in reality, behind the scenes, a lot of stuff is happening, and a lot of serious people are involved in developing projects in the space. And that's just one of them. It's not us. But it is a project, it is a team that we're working with. And these guys behind it are some very, very solid professionals, and they're actually backed by two very prominent life insurance companies. So Bitcoin is not something your brother-in-law is trying to push you to speculate on only. It's actually proving its use case for very serious businesses. So.
Yeah, sure. It's funny you mentioned Teambrella. That may well have been something I wrote. Did you say? Because
I think it was.
I wrote several articles on Teambrella, and at the time we were talking more around the kind of peer-to-peer insurance. You remember probably about 5 years ago there was a big thing about how we were going to essentially take out the insurance middle layers and have more of a peer-to-peer. And that didn't kind of work. But I think it was the foundations of the idea was solid, but probably it was just a bit too early. And of course, now when there's some things I see around DeFi insurance, you just think, well, actually, it's pretty much the same, because you are moving to a more decentralized platform where actually you're just taking out these middle layers, which, let's face it, in insurance, the value chain is massively bloated with handoffs. Yeah, get it. Okay.
And Frank, I think back 5 years ago, I think the worldwide, number of crypto wallets was around 50 million people, if that. Today, I think, latest estimates, plus or minus, is in the sort of 300 to 400 million range. And it's obviously, ahead of its time. And it's a shame that the project itself wasn't able to sustain itself, because I think some of those, certainly for me, the learnings, when I read on your interview with them, has been helpful for us. So
I often put it into context for people to say, look, if you go back to before 2000, in the early days of the internet, the number of users on the World Wide Web was only about 300 million. And, now you've got the entire world pretty much on the internet, and you've got more mobile devices. Yeah, exactly. And so to put it into context, people talk now about Bitcoin. Oh no, we go down that road, and that's just a fanciful fantasy that will never come off. And you say, well, people were saying that just 25 years ago, which is I've been alive longer than twice that. So we kind of like seen that come and go. And that, you put it into context, you think, well, maybe there is something in that, and I wouldn't write that off.
But broadly speaking, our focus outside of life insurance is around commercial or general insurance. So we don't utilize Bitcoin as an asset class in that regard. We use stablecoins, and stablecoins is really in some of the most rapidly growing, segment of the broader cryptocurrency economy. Approximately about $150 billion market cap today, but on a daily basis, about $100 odd billion get traded every single day. in stablecoins. And stablecoins, for your audience, are cryptocurrencies that are pegged to an underlying fiat currency. Usually, there are other versions of it, but we stick to ones that are backed either with dollars or euro, or in some cases Australian dollars and others. So they provide the stability, hence the term or the name, that enable people to transact in a way that they're not having to deal with the fluctuations and volatility of some of the other cryptocurrencies.
So there's kind of two sides for the stablecoin. The point you just made there, Joe, which is right, which is that it's pegged one-to-one with, say, the US dollar, which is the main one, and therefore that gives it stability. So this whole question of that crypto volatility goes away because it's tied to the dollar. But the second thing is you get all the benefits of the frictionless the ability to trade and move essentially value around on a cryptocurrency network, which removes all of the friction and the cost that comes with just moving ordinary money. Anybody that's tried to do remittances or send money overseas or even just buy something online, you end up paying a significant amount of money. And of course, you're getting all the economic benefits of a stable coin plus the stability of it because it's tied to the dollar.
Yeah, and of course, the other key benefit for the insurance industry and just the whole concept of it is a smart contract. So smart contracts, again, for the layperson listening in, is programmatically taking the obligations of a conventional insurance contract, be it, X to happen, a claim gets paid, but making that programmatically embedded within the blockchain so that a user has that assurance to know that they're not, if a certain event happens, that again, programmatically inbuilt into that obligation between what we call the cover pool, and it's not going into too much jargon, and the cover holder, it is done programmatically. So it minimizes or ideally avoids completely the need to call up a claims department or send a fax or an email or phone call. As anybody knows, it's a painful process, particularly in a moment of need. So to be able to automate that process using smart contracts, it's almost like the whole technology was built for the insurance industry, in my opinion. But it's something that is, obviously very underutilized at the moment. This is where we have great aspirations for what we can do with that.
Yeah, sure. So how does the business model work in the DeFi insurance space, and of course, why does that make a difference to Joe Public? I mean, how is that actually going to, is it just a different way of doing exactly the same thing, or is there a real kind of upside to personal industry?
I believe there is. I mean, it comes down to, as you described earlier, the bloatedness of the entire pricing structure. Overall, if I can talk back through the different waves of innovation that has happened, and you've been the front row seat of and writing about and speaking about around insurance and digitization, etc. Most efforts in the last wave, called pre-blockchain, was around how do you eliminate or how do you get rid of the intermediaries that are taking their commissions. And by and large, that strategy hasn't really worked that well, with a few exceptions, of course. In large part, it's just the nature of insurance. The old adage that insurance is sold, not purchased. I think it rings true, and I think in our view, we view risk advisors, brokers, and the like as actually value adding, because they do generate business for the pool. So in our case, what we do is, where is the rest of the bloat? And we view that as the corporate overhead. By accessing different types of capital, in this case, stablecoin pools, and different sources of those stable pools, we can create essentially a marketplace of different underwriters, and without the overhead that would need to be added that would, in by conventional underwriters. So we go to different hedge funds, we go to accredited investors who own crypto assets, in which typically a certain portion of it are in stable coins, and we offer them a way to generate yield outside of their current mechanisms of DeFi yield. So it's an attractive proposition. You go to most hedge fund guys and say, would you like to be a Warren Buffett on the blockchain? And their eyes open up. So, and of course, not everyone understands insurance risk, but a lot do. And so what we do is we go, okay, we'll create what we call a cover pool, which is essentially a risk pool around different types of risk. And we'll have those pools funded by those types of investors. So crypto hedge funds, credit investors. And of course, we're always open to the more traditional reinsurance syndicates, but we view that as a step process. We match that using smart contracts, which I described earlier, with cover holders that are introduced by risk advisors. One other key innovation is that we take, and of course I say this jokingly, we take the actuaries out of the dungeons and the basements of big insurance companies and give them the opportunity to become what we call a delegate owner. So they are in effect sharing in the economics of the risk pool. So they are able to benefit financially from the profits, the underwriting profits that can accrue from well-priced cover pools. And they participate in more of a leadership role in how to design and price different products linked to those pools. We have over 60 actuaries in our network that are designing and developing products for us. And we obviously connect that and match that with our programmers. We're developing the smart contracts that codify those obligations that are written into those products.
Got it.
So the net result is that the end user or the cover holder, so that could be Joe Public, it could be a business that's trying to get directors and officers insurance, it could be myself as a single dad needing to get life insurance. We're able to get that at a price point that is significantly lower than you would get traditionally, because we've gotten rid of some of that, well, a significant part of that overhead. The other key part of it, why this can actually this work in this era, is because you're able to see the proof of reserves at any given time. You're not only having to rely on the regulator's stamp of approval, you're not having to rely on the annual report of this insurance company or their balance sheet. You can literally see what are the reserves like, what are the transactions, what are the claims that are going through it. It's completely transparent. So in this case, quite literally, the emperor has no robes because they are completely open and transparent to. So it's the opportunity for this, because this technology enables this to happen for a startup concept like this, because it's no longer having to rely on trust or promises of a company. It's literally you can see the reserves.
Got it. So the traditional way of looking at insurance remains the same. That essentially you have a pooling of lots of people, right? Everyone in the street puts 100 quid in, and then if there's a fire in the street, there's a pot of money, and everybody's sharing that risk. And so the fundamental principle of insurance is exactly the same. But what you're describing, Joe, is the execution of how that insurance policy, that insurance cover would work. And in today's world, there are lots of handoffs and lots of different parties, and everybody takes their piece. And so you could have an insurance product that for every pound, dollar, or euro that is you pay for it, maybe only 20 or 30% actually goes towards insurance risk, because the other 60, 70% is lost.
Exactly right.
It's lost in all the handoffs. And most people don't understand that. And not only is that a friction and a cost that you were talking about, you can take out and therefore pass on that benefit to consumer or the person that's buying insurance, but also you make the whole thing much more efficient and much more effective. Okay.
Exactly. And we also, we use the term in the industry is trustless, basically. And it's meant to be like, I don't need to have to trust you by what, you're advertising, all the sponsorships of football teams, or the, look how old we are, look how big we are. All of that is irrelevant. Just show me how much you have in your treasury. Yeah. And it's a hugely advantageous position to be in.
Again, just as sort of for clarification, this notion of, we talk about the blockchain, and and I say to people, look, you don't have to worry about it any more than you don't need to understand how the cloud works. You just need to know what the utility of it. I mean, everybody, my mum will say, oh, my photos are in the cloud. But if you try to get to explain what that means, she doesn't know, but she doesn't need to. And the thing with blockchain is it's a technology that allows transparency. That's the way I always describe it. You kind of have a common ledger, right? A common database of the information, and everybody gets to see it. And this is a radical change from the way all businesses work today, because everybody has their own copy of their system, and everybody has it slightly different to everybody else. And so where do you see DeFi as a sector, as a space, particularly around insurance going? I mean, I was looking at some numbers, and I think the amount of kind of embedded value or locked in value that they call it in the DeFi space was about $250 billion at the end of last year. And it's kind of come down as the whole market, equities have come down. Meta, Facebook is down 60%. Bitcoin is kind of holding steady around $20,000. I hear people saying, oh, well, DeFi is dead. It's kind of a bit like P2P insurance 5 or 6 years ago. It was a fancy thing. Where do you kind of like stand on that? Are we at the beginning of a new era, or are we kind of at the end of a project that was worthy, but not really sustainable.
Naturally, obviously, I'm in the business, so I have a biased view, but in sort of talk through that, I mean, you referenced the first .com wave, which I was also a young 20-something startup founder at that time, and I had similarly raised venture capital, grew a business, hit the wall, and the capital markets or the venture market went dry for a period of time. The biggest mistake I made was leaving that sector, because I'm kind of like everybody else, mostly. Not everybody, Elon stayed and a few others stayed on, and the rest is history. But I see very much the parallels. If you can understand the level of activities done by what I call very serious professionals is continuing to happen. The tourists, the NFT, JPEG type projects, they're certainly, I think their time is up, because I think that was a moment of, creative expression. But the number of actually serious use cases and commercial applications that I'm certainly aware of on a first level basis is quite extraordinary. I know groups of former investment bankers that are raising, although actually I should say have raised $300 million for, again, DeFi based lending to real world assets, and these are real businesses who are, again, able to capture the benefits that we've just described around insurance, but in their case around debt. It's just happening. I think it's painful, because obviously if you're raising capital to grow your business, it's a lot harder than it was 8 months or maybe 12 months ago. But I think this is healthy for the business. I think it's wiping out some of the more fluffy projects, and so I think it's the beginning. I think it's the beginning of tremendous change. I don't think it's if this is going to happen. I think it will. It's just a matter of when. And certainly I think we can refer to other waves of technology, and we talked about it with the internet. So.
Yeah. Joe, I'm 100% with you. I think we're at the beginning of what they call Web3 or the next generation. Sure. I think we're at the beginning. I've just done a piece of work where I've tracked about 250 consumer brands, global brands, from my tagline, from Adidas to Zara and in between. Right. And I was actually surprised at how many mainstream commercial brands are running projects in NFTs or on blockchain or with virtual reality and the kind of the metaverse thing. From Accenture onboarding 150,000 staff through virtual reality rooms to Hennessy. I've just done a piece about Hennessy, the cognac brand. They've got this Web3 DAO social club with NFT membership. And the point is that we've moved on, I think, in a very short period of time from the kind of the Bored Ape yacht club. For the listeners that want to find out more about Joe and Autonomous and what's happening, what's coming next, where do they find out more about what you're doing? How do they follow you?
Thank you. Well, you go to our website, Autonomous, and we spell it differently. We drop the O, so it's autonomus, US at the end. That may trip some people up. .insure. We're obviously on Twitter and Telegram on the same handle.
I'll put all the links in the in the video, in the YouTube video. So we'll do all of that. Joe, look. Thank you. That's been a great chat. We've kind of like run out of time. Thanks so much. I would like to, I think there's more conversation to be had. I think there's a sort of a deeper conversation to be had. Maybe we'll set that one up for another time. But for now, thanks very much. Enjoy your evening in Melbourne. I'm now going to go. I'm going to go and have my breakfast in Spain.
It's good to see you, Rick. You've changed a lot in the years. I've seen you. This new look, Rick, compared to the old corporate insurance guy.
The beard basically is the main difference. For 35 years, I worked in corporate, and I always used to shave every day, and so now that's kind of it. That's it. So I have the beard, and it's just that how it changes. Anyway, Joe, look, you have a great day. Lovely to chat to you.
Now, before you go, let me tell you about brand strategies for Web3 and the metaverse. I mentioned it in the video. It's a unique collection of over 250 consumer brands and their use cases in NFTs, blockchain, virtual reality, and crypto. For a limited time only, you can access the database for $26 using the discount code BRAND50. That's BRAND50, and the links are all in the comments. Also, check out my website, which you can see here. And if you want to know what's happening and what's coming next in the tech economy, join the mailing list and get a free newsletter every Friday. Also, check out my podcast
called Big Tech, Little Tech, which I do with Sean Weston. And remember to like this video and follow me so you don't miss any video and all that kind of stuff. Till next time, and remember, insight and information gives you leverage.